I do have to focus at $70 a barrel on the responsiveness and dynamics of oil price to, say, ExxonMobil's free cash flow. Is Exxon a real oil company now, or are they a bank that happens to run oil? Which is it, and what are they going to do at $70 a barrel?
Thanks for having me on, Tom. That's a very interesting question. We do think they are a real company. At $70 a barrel, there are a lot of options, but I think that the main drivers of major stock performance recently has been twofold: dividend sanctity and timing of cash returns to shareholders. And so at $70, we think that it's a matter of when and not if that Exxon starts returning incremental cash to shareholders. And we think that could probably happen in 2022, because that's when they get within the range of their debt reduction targets.
Their 10-year per year return is a travesty. Their 20-year, 10-year return is how CEOs get fired. What's the new religion at ExxonMobil?
Well, the new religion is that there's been a paradigm shift in energy broadly, I would say. There's a focus on go-forward cash returns, and there's a significant high grading at Exxon for the projects going forward, which should exactly change the track record of the core ROCE going forward. So there's a paradigm change in energy, focus on free cash flow, focus on capital discipline, and the current management team is very focused on reducing capex to the lower end of the range this year, and they've dramatically lowered the medium-term capex to 20 to 25 billion, which is about 10 billion lower than it was before. So we think that the go-forward Exxon is a much different company than the prior 10 years that you just mentioned.
How high, Jeanine, do prices have to go before U.S. shale producers, before marginal U.S. Oil drillers actually get back into the market and produce more?
That's a good question. I think that's everybody's fear, is that with higher oil prices comes more U.S. supply. But what we've noticed in our companies, not just on the U.S. major side, but also with the large cap U.S. E&Ps, is that the supply response has been very muted to higher oil prices. And we don't see that changing in the next couple of years. And that goes back to the paradigm shift that we talked about. Investors know that it's a now or never for these companies to prove that they're real companies, that they can return cash to shareholders. And so we think that the supply response will be very muted going forward. Generally speaking, our companies now are much more vocal and aware of the macro conditions around them, indicating that right now the world doesn't need their oil, but they're looking for global inventories to stabilize, they're looking for curtailments to come back, and they're looking for oil demand to come back to 2019 levels before they even consider growth. The one caveat there is we're keeping our eye on private production, given that it's become a much bigger part of the U.S. supply picture.
So, Jeanine, how much of what you're seeing with respect of discipline has to do with what you're talking about, which is that it might take some time for things to get back to the levels of demand in 2019, and how much has to do with the push by shareholders for climate change activism and some sort of response from the fossil fuel producers?
I think it's both. I think that the capital discipline is alive and well, and we keep seeing more and more data points for that. And I think the push for climate change really is making companies more aware that they've got to look at the overall macro picture. It's not just every company out for itself. And with investors demanding climate change, the energy transition is only going in one direction. So that kind of biases production lower. And let's not forget that investors are really demanding returns and cash returns on and of capital going forward, which historically this group has not done a very good job at.
Jeanine, what does engine number one want from the Exxon board, Exxon leadership, and do you disagree with them?
Well, we don't necessarily disagree with the nominees that Engine One has proposed. I think certainly they all have merits. And broadly speaking, I think that the market really wants to have change in the Exxon board. So I think Engine One is really looking for transparency and for more energy experience. Where we kind of differ from other maybe opinions is that we don't necessarily think that a major change in the board or the strategy of Exxon would necessarily benefit shareholders. And this kind of goes back to your first question, in that we think the current management team has done a really good job changing the complexion of the company going forward. So between one, maintaining the dividend last year when oil prices were crashing, two, reducing capex to historically low levels from what you would expect them to do, and three, most recently, executing on quarters, we think that the management team is actually doing a pretty good job right now. So a major shakeup we don't think would be the watershed moment that maybe others do. But we do think that the company would benefit from lowering capex further in the near term and lowering capex to at or below the low end of their medium-term budget.
Could you put some numbers on that for us, Jeanine? And is this upstream capex, and how big would that cut be?
Right. So this is upstream capex that we're talking about. So, for example, if they go to about 19.5, 20 billion of capex, we think that they can get all of their plans done in the medium term and produce a decent amount of free cash flow. So free cash flow is really the key for the sector, because that's how you get cash returned to shareholders. That's how companies prove that they're real companies. And so for Exxon, if they do that, what we're saying is lowering capex at or below the midpoint of the medium-term guide, we see free cash flow averaging about 3.6 billion per year on average through 2025. And that would allow them to both pay down gross debt and increase the dividend.